welcome to another class on IAS 40, investment property. Investment property is one of the tangible non-current assets, as we discussed in our first class. Is that clear? So the focus of the class today is to treat in detail investment property for corporate reporting and financial reporting, or for any undergraduate doing IFRS or IAS. Now, straight to the business now. What is investment property? Investment property is governed by IAS 40. Is that clear? Now, this is land or a building or part of a building or both. So it could be land or a building or part of a building or both, held to earn rentals. Is that clear? Or for capital appreciation, or both, rather than for use in the production or supply of goods and services, or for administrative purposes, or sale in the ordinary course of business. Now, what are we saying here? Investment property, number one, is a tangible non-current asset. It could be a piece of land or a building or both. Now, which is held to earn rentals, to collect rentals every year or every month, or for capital appreciation, that is for increase in the value of the land or the building. Is that clear? So for what? For rentals or for capital appreciation, but they are not for normal business operation. Now, in the first class, I talked about those standards, that are connected to tangible non-current assets. I talked about IAS 16, property, plant, and equipment. Property, plant, and equipment. It is the tangible non-current asset that is used mainly for the business, for owner use. So that is why any tangible non-current asset that is held to collect rentals or for capital appreciation is regulated by IAS 40. So the objective of investment property is simply for what? For rentals. For rentals, to earn rentals, or for capital appreciation, or both, or both. Out there, I could have a piece of land, and what, and rent it out, let's say yearly. I have money. While the land is being leased out, it is also appreciating in value. Exactly. So I stand to get two things: the rent and the capital appreciation. Next, now, what are the examples of investment properties? Now, you should know the examples of investment property, because it is not all the tangible non-current assets that are qualified as investment property. Examples are: one, land held for long-term capital appreciation. Probably you have a piece of land somewhere, you bought it years ago. Your uncle dashed you money, or you got one money, or your pension, you bought the land, and it is kept, to grow, to appreciate with that intention. Then it is an investment property. Two, land currently held for undetermined future use. Now, this is very common in the question, but students are confused. Now, when you have a piece of land that the future use is not determined, IAS 40 says it should be what? Treated as investment property, because as the land is there, it is what? It is appreciating in value. Third, now, a property property that is being constructed for use as an investment property. Now, you are building a building, okay, right, for an investment property. 4. A building owned by an entity and leased out to another party under operating lease place, okay. Operating lease is just like what? Your normal rent, okay, your normal house rent. 5. Now, a vacant building held to be leased out under an operating lease. So you could browse more for more examples of an investment property. Okay, you must at least know 5 often. Next, please. What are the examples of non-investment property? Examples. 1. A property leased out under finance lease. Yes, when a property is leased out under finance lease, it is what treated in line with IFRS 16. Okay, that is what lease. 2. Owner occupied property. Okay, any owner occupied property is what is treated in line with IAS 16. Property, plant, and equipment. 3rd, property held for sales in the ordinary course of business. Probably your own is to construct, okay, or to build and sell. Okay, so that is considered as your inventory. Since that is your operation, you build, you sell. So that is what treated by IAS 2. For now, property being constructed on behalf of the third party. Yes, that is under IFRS 15. Okay, revenue from contract with customers. The last now, property being classified as held for sales. Now, when an organization decides to classify one of its tangible non-current assets as held for sale, then it should be what treated by IFRS 5 and not IAS 14. Now, you have now learned the meaning of investment property, examples, and non-investment property. Next now, recognition criteria of investment property. Recognition, okay, according to the conceptual framework, is the process of incorporating an element of financial statement in the books of accounts. Is that clear? So now, what are the conditions that must be fulfilled, right, before an entity will recognize an investment property, that is, bring it into their account, okay, as part of their tangible non-current asset? 1, if it is probable that the future economic benefit associated with the property will flow to the entity. That is, if it is certain that we are going to derive, we are going to enjoy, we are going to receive the associated benefit. That talks about control. Okay, I have control over it, so I am going to enjoy the benefit. 2, the cost of the property can be measured reliably, right? The cost of the property should be measured reliably. Is that clear? Next now, stand up. Next now, measurement of investment property. Measurement. Now, according to the conceptual framework, right, measurement is the process of determining the monetary value of an element of financial statement. Is that clear? Now, when we say elements of financial statement, they are just 5. 1 is equity, 2 liability, okay, 3 asset, 4 income, 5 expenses. So we are talking about asset now. Now, how are we going to determine the value of the investment property? So the process of knowing the value is what is called the measurement of investment property. According to IAS 40, investment property can be measured in two ways. One, at initial measurement. Two, subsequent measurement. When you say at initial, you are saying what is the cost of this investment property for the first time. Okay, you are saying the cost of that property for the very first time. Now, it could be purchased investment property or self-constructed investment property. So it depends, okay, on the angle from which it is being examined. If it is a purchased one, right, look at the cost of purchase and every directly attributable cost, okay, that is incurred, right, to purchase that property. Now, if it is a self-built, okay, you are trying to build it by yourself, all the cost that has gone into the construction, direct material, direct labor, borrowing cost, and other necessary costs. Is that clear? Now, at initial now, okay, the investment property is what measured at cost plus transaction cost plus what transaction cost. Next, now we are going to take a sample, okay, to see how to determine the value of an investment property at initial measurement. It is normal that you know the value you are going to bring into your record. So that is done at initial measurement. Now, subsequent now. When you talk about subsequent measurement, you are saying how are you going to determine the value, okay, of that investment property at the end of each accounting year. Is that clear? At the end of each accounting year. That is the subsequent measurement. According to IAS 40, investment property can be measured subsequently. That is, an entity can use any of this method. One, cost model. Two, fair value model. Is that clear? Now, when your organization chooses cost model, it means that the investment property will be what? Carried at cost, less accumulated depreciation and any impairment. So it means that you are going to depreciate that investment property just like what? Your PPE. So the value will be the cost less depreciation and any impairment to get the carrying value that will be in the balance sheet or our statement of financial position, while the depreciation and the impairment will go to the P&L or the income statement as an expense. That is cost model. Okay, you are going to depreciate that investment property over the useful life, just like your normal IAS system. Next, now, fair value model. Now, fair value model, when your organization chooses to measure its investment property at fair value model, what are we saying? That investment property will be carried, okay, at the end of the year at the fair value. It will be what? Carried at the recent market price, okay, recent market price, okay, of that property based on location. Now, when you choose fair value, in the question, they will give you the fair value at the end of the year, and you are going to compare the fair value at the end of the year with the value at the beginning of the year to show or to determine what the difference between the values. Is that clear? Now, if the fair value at the end of the year, let's say, is 500 million. Okay, the value you got from the market, and the value, okay, you have on record is 400 million. Then 500 million is what is more than 400 million. There is a fair value gain. So the fair value gain or loss is reported in the income statement of the year, while the investment property is carried in the balance sheet or in the statement of financial position at the closing fair value. Please take note, under the fair value model, you are going to carry that investment property in your balance sheet at the closing fair value. At the closing fair value. So these are the two methods, okay, by which an entity can measure its investment property. So let's say now, okay, a work example. Pause. Now let's take a work example now out there. This is the first question. Pathfinder Limited is a property development company. It is in the process of constructing commercial spaces which are to be rented out to third parties as an investment property. Pathfinder Limited has incurred the following cost: cost of land, market research, architect fees, legal fees, stamp charges, and construction cost is is 103. Exactly. Now required, compute the amount of the investment property that can be capitalized and expensed according to IAS 40. Now this is a question that takes the initial measurement. How then? The initial measurement. Remember that at initial measurement, the investment property is what is measured at cost plus other transaction costs. So let us determine the cost of it now. Let's move there. Of this now, the cost of the investment now. Say solution. Out there. Okay. Capitalize cost of investment property. That is what you pay the cost. Listen now. Like I told you earlier, okay, when it is self-constructed, just look at the relevant cost. One, the cost of land, okay. Cost of land is how much? 40 million. Next, market research. Market research is not a relevant cost, so there is nothing about what you are researching here. Okay. Next, architect fee. That is 2 million. Next, legal fees. That is also 3 million. Next, stamp charges. Yes, stamp charges. Stamp charges is how much? 3 million. Next, construction cost. Construction cost. That is what? 50 million. So this is the total cost of the investment now. Okay, that will be what? that will be brought to record. That will be 98. So capitalize cost. Note now. Now, there are relevant costs and irrelevant costs. Market research, okay, should not be capitalized, should not be added to the cost of the investment property. Therefore, it should be expensed. Market research excuse me, of 5 million should be what? Expense in the statement of profit or loss for the year. Out there. So you are what? You are going to expense market research. Okay, it is a non-capitalizable expense. So what we have just done now, okay, is to show us how to determine the initial cost of the investment property. So this is the cost now at initial measurement. Thereafter, at the end of the year, okay, that is what there is subsequent measurement. You can now choose, should I use cost model or fair value model? But for the very first time now, on this date, this is the cost of that our investment property that will go into our account. So let's see now the next question. Pause, please. Okay, now, so this is the second example, right, on investment property. So this example will show us how to treat subsequent measurements of investment property. Now, Thompson Limited, a manufacturing entity, out there, purchases a property for 2 million on 1st of January 2000 for its investment potentials. Okay, it is clear that what it is what meant for investment purpose potential. The land element of the cost is believed to be 500,000. This the land of this 2 million. Okay, this out of this 2 million, the land is 500,000, and the building is expected to have a useful life of 50 years. As at 31st December 2000, local properties indices, okay, suggest that the fair value of the property has risen to 3 million. Meaning what? At the end of the year now, 31st December 2000, the fair value of that property now is 3 million. Required. Show how the property would be presented in the financial statement as at 31st December 2000 if A. Thompson Limited adopt the cost model, B. the fair value model. Now, when you hear, okay, that show how a transaction would reflect in the financial statement, okay, they are asking you to what? To prepare financial statement extract. Is that clear? And that is your income statement and your balance sheet or your XOFP. Now, using cost model. So let's see now how we are going to account for this, okay, using cost model. Yes, please me here. Cost model. It's good. Using cost model. Small. Come here. So using now, I told you that under the cost model, you are what? You are going to depreciate, right? So the cost now of the property is 2 million, right? And from this cost, 500,000 is for land. So land here is 500,000. So it means what? Building is what? 1.5 out there. And you only depreciate building. So the useful life of building is 50 years. Out there is what? Is 50 years. 50 years. Out there. Now, what is your annual depreciation? Annual. That will be the cost. Your annual depreciation is the cost, right, of the building over what? Estimated useful what? Life. So the building cost 1.5 over what? 50 years. So how much you charge now per year as depreciation? You are charging 30,000. So now the financial statement extract. Hello, please, in your exam, let the workings come down, okay, please. Let the workings, because I am teaching here, so your workings should come down. Let your answer come first. So statement of profit or loss for the year ended 31st December 2000, right? 2000. Hello. Now, what item out there will come here? The only thing is what is your annual depreciation. So depreciation on what? On building. How much is that? 30,000 under the cost model. Out there. Next now, your statement of financial position as at 31st December 2000. I told you that when you measure your property as cost model, number one, you are going to depreciate, and the closing value of that property will be the carrying value. That will be what? That will be the cost of the property less the total depreciation. Here you have non-current assets. Out there, you have property, okay, at cost. What is the what? What is the cost here? Your cost. The cost now, okay, is what? Is 2 million. 2 million. So let's now depreciation. How much is what? Is 30,000. So This is what the carrying value, okay, of the property at the end of this year. That will be 1,970,000. So this is what the carrying value of the property. So under the cost model, right, this is what the treatment. Is that clear? So let's see now. B says the fair value model. Go there. So the fair value model. So when you use the fair value model, I told you that according to IAS 40, if you are using fair value model, okay, for your investment property, number one, there is no depreciation. Number two, you are going to revalue it every year to fair value. That is, you are going to get the fair value at the end of each year to compare with the value on record to see is there a fair value gain or loss. So the fair value movement, okay, will be reported in the income statement as either fair value gain or loss. The last is that you are now going to carry the investment, okay, at their closing fair value. So now your income statement, now your statement of profit or loss for the year ended at the 1st December 2000 out there under the fair value model. Now what is the fair value? The now listen now. As at 31st December 2000, local land property indices suggest that the fair value of the property has what risen to 3 million. Meaning at the end of the year, it's now what 3 million, but at the start is 2 million. So there is a fair value gain because the value of the property has increased. So here you have fair value gain of how much? 3 million less what? 2 million, right? You have 1 million. You have 1 million. Is that okay? You have 1 million. So the fair value gain will appear in the income statement. Last now, statement of financial position as at 31st December 2000. Out there, non-current asset. The property now, okay, is what is not to be shown now at the closing fair value because that is the new worth of the property. So 3 million. Now we can see the difference in the treatment, okay, between the cost model and the fair value model. Under the cost model, you are going to what? You are going to depreciate, okay, the investment. Out there, the investment. But under the fair value, there is no depreciation. Is that clear? So this is the end of the first lecture. Now we have a look at the notes on the investment property, and the first question was on how to determine, okay, the cost of an investment property at initial measurement. While the second question help us to determine how to account for subsequent measurement using the cost model or the fair value model. So thank you very much.